Holy smokers, folks. I hope everybody's ready to get their flapjacks flipped. Earnings season is here. Jamie Dimon just came out and gave a pretty dire warning to the stock market, to the economy, to a lot of things. And I'm going to put all these pieces together and kind of show you guys what's going on in these three different parts here, essentially. There's so much going on in the stock market right now that's very, very interesting. We're in, I would call it one of the most intriguing times in the stock market I've seen in a long, long time, to be honest, other than obviously Rona. We're in a moment in time where there's so many things that are acting, let's call it strange. And some of those things I want to show you in this video here today. Hope you guys enjoy this. As always, I appreciate you joining me. First thing I want to show here is the NASDAQ over the past 2 trading days has done absolutely nothing. The stock market in general over the past 2 trading days has done absolutely nothing. It went up, it went down, it went all around, but at the end of the day, for the last 2 days, this market has done nothing. And that is shocking. To be honest, it's just shocking, okay? Here we are in this moment. Let's just think about what's happened over the last 2 days. CPI numbers came out much worse than most folks expected. We got a 9 number, which we haven't hit the 9s since the 1980s. Like, it's been like 41 years since that happened, right? We just had bank earnings came out, not good. We're going to go through some of those numbers. I'm going to show you, okay? Fastenal came out with earnings, not good as well. And so here we are in this moment in time where we're getting some really bad news here and some really kind of shocking information, but it's kind of being a little brushed to the side right now. And you kind of got to wonder, like, what's going on here? Is this just like a pump fake here, or are we set to go down a lot more and things like that, right? Look at Amazon over the past 2 months. This stock has gone absolutely nowhere for the past 2 months. And this is the thing with the stock market, is it can go through these time periods when even sometimes you're getting some massive news. When you talk about big banks reporting, when you're talking about CPI numbers coming out, and especially right now in this moment of near hyperinflation, right? When you're in this moment in time, like this is huge news, and you can get the market to not move. And this happens to stocks all the time. Amazon, no one's buying or selling the stock in any meaningful way the last few months. The reason being is no one knows, no one has a strong conviction around Amazon stock, for instance, right now, right? It made that one kind of upward move when the stock split thing happened, but outside of that, no one has strong conviction around Amazon, right? Wall Street's not ready to go out there and buy Amazon hand over fist, and no one's really ready to sell that stock in any meaningful way. And so what happens? In a 2-month span, the stock goes literally nowhere, right? Google McDougal. Look at the stock the past 2 months. It has gone absolutely nowhere, right? Up, down, all around. But people are like, well, I don't know how ad rates are on Google. I don't know how ad rates are on YouTube right now. So I don't know. I don't really want to sell the stock, but I don't really want to buy the stock either, right? You look at a stock like Tesla, Look at the stock the past 2 months. It's done nothing. Nothing. It hasn't gone up or down in any meaningful way. It's gone boop, 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 boop. But at the end of the day, it's done nothing for 2 months now. 2 months, right? And but you pull it out a little further, right? Look at the year to date for Tesla. Yeah, it's done nothing the last couple months, but the stock is still down massively, right? It was down 40%. And so that 40% move, right? That was the market kind of adjusting to obviously the wall of worry, which we have going on right now, and obviously getting valuations down. But now, in order to get Tesla stock, let's say down to $500 or something down there, right? We're going to need Tesla earnings to start falling off. So you're going to need to see Tesla come in with weak EPS, weak net income, weaker margins that are hurt, right? And maybe just overall worry commentary. If you get that, then you can get the stock down to $500 or so. Outside of that scenario, Tesla's in no man's land right now, like many of these stocks are. They're just in complete no man's land where people are like, and just kind of holding on, not much buying activity, not much selling activity. And so, yeah, if Tesla has bad earnings and people are in Wall Street makes up this consensus about like Tesla is going to have their earnings, continue to get worse and worse over the next year and a half, then that's a situation the stock goes down. That's the same thing for all these stocks that are in no man's land now at this point in time. But no one really is that confident in it. And that's why these stocks haven't done anything the last couple months, is now everybody's like, okay, I got to see proof. We got these stocks down, but now I got to see proof that earnings are going to materially disintegrate for these companies. And if you don't get that, then you can't get these stocks to kind of take the next leg lower, right? I looked at today, and specifically, and I pulled up my big tech watch list, and I was looking, and the 50% plus down crowd was all down huge today. Well, relative, right? Shopify was down 4.6%, Uber was down about 4%, Meta was down 3.3%, PayPal, Snowflake, and Netflix were all down as well. And so here we were in this divergence where the stocks of big tech that are down less than 50% actually did pretty decent today, but the stocks that have been the most hurt of big tech were all hurt more today. So I just thought that was pretty interesting to bring up there. I was looking at the travel watch list, and I was just thinking for a moment, right? And I was looking at some of these different stocks, and I was thinking about CCL, and I was just thinking, like, man, this was a $40 to $50 stock before Rona, right? Today it's $8, and I was just thinking, like, I still feel like inflation, all the stuff that goes on out there, right? And all the wall of worry. I still feel like the scariest thing I've ever seen in the stock market was Rona. I mean, there was a moment in which the government ruined companies. Like, the government chose to ruin companies, right? Because they thought it was going to save the public or something like that, which is very, very debated if that was the right move or not, right? But the government ruined Carnival Cruise Line. That stock would not be $8 today if it was not for the government saying, no, you guys aren't allowed to sail for years and years and years, right? Same thing with RCL, same thing with a lot of the airline stocks. Like, that was the government's decision to just shut down the world and ruin those companies. And it's just crazy to think like the government can just come out and ruin massive corporations like that because they believe, such and such and such, right? Just, something that kind of food for thought, right? I thought this was worth bringing up here, okay? I was looking at SOFI here today, and I've been doing, research on and off for SOFI for the last few months now, but I was looking at that stock here today, right? And before earnings, this stock was in the 5s, and then they actually reported pretty darn impressive numbers, and the stock climbed to the 7s, and then here we are in this moment, it's back to the 5s again, right? And the reason you see something like that play out, and the reason something like that's important, is no one has any sort of lasting confidence in this market. We have confidence issues everywhere right now. And it's got funny. You just wait till the confidence issues we're going to talk about in just a moment. That's going to make you guys laugh, okay? I've never seen anything like this in my life, okay? But we have confidence issues in consumer confidence. We have small business confidence that's near record lows. Like, it's insane how bad that's fallen off. We have investors have no confidence right now, right? You get a stock to maybe report a good earnings, it goes up a little bit, and then it's just straight back down because no one has any confidence that anything can last right now. There's massive confidence issues in the overall financial markets and in the overall economy and business landscape right now. And I think that's apparent when you look at a stock like SOFI that had those good earnings, stock spikes to 7 something, and then just falls right back down because lack of confidence, right? Now, this is a company that I was looking at SOFI, right? They've grown massively revenues over the years, but they're a huge money loser on the bottom line, obviously, right? And so in this sort of market, when folks have confidence issues, they just can't buy these sorts of stocks. And that's why these stocks are just floundering right now, right? The money losing companies are just, they can't do anything right now because no one has any confidence. And in order to get moves to be sustained in these sorts of stocks that are huge top line growers but money losers on the bottom line, you have to be in a market that has confidence. Right now, we don't have any confidence in this market. And so that's why these stocks just continue to just, if they get any gains, they just sell it right back off. And then they're just floundering in this, 5, 6, whatever dollar range that they've been in before, right? And that's kind of what's going on there. Now, I was looking, right? And my gosh, is this stock market dead right now? And first thing to understand is we're in summertime right now, right? So the summertime, generally speaking, volume's a little light in the stock market, okay? That's generally true. However, this is a bit of a freakish year in which we have this massive wall of worry going on. We got crazy inflation going on. We have massive worries about recession that we haven't had in a long, long time. So this is a bit of a different year. This is one of those rare summers that you should see volume be pretty much in line with where it usually should be. And the reason being is because of everything going on, right? But I'm looking and I'm like, man, is the stock market dead right now? Robinhood had less than 8 million shares trade today. Average volume's 20 million. Like where's the action in the hood? Like, where is the action? There's absolutely no action in that stock. By the way, it's trading for right around the same. Whenever the stock goes to low 8s, or especially if it goes to high 7s, it basically starts trading at less of a market cap than it has cash. So it's just something to just kind of keep in mind, which is, very rare you see companies do that, right? I was looking at the chef here today. 400,000 shares traded, average volume's 571. I mean, heck, at some point I'm going to probably have over 400,000 shares of Chef. And I mean, geez, it's just crazy, like how low volume is there. There's just no action, right? Look at Meta, huge company. Meta, where's the action? 22 million shares traded today. Average volume's 33 million. So, I mean, that's like, a third or whatever, or, 2/3 of the normal action. That's just very, very low, very low volumes out there, very low volumes. And yes, it's summertime, so volumes are supposed to be lower, but this is kind of incredibly low considering the market we're in, and just nuts to kind of see like how little action. Look at Netflix. 8 million shares traded today, average volume's 14 million for Netflix, right? Just no action in this market. Amazon, less than 50 million shares traded today, average volume's 90 million. I mean, come on, man. There's no action. All right, now, this is very, very important. This is crazy headline, okay? First off, Morgan Stanley profit falls 29%. CEO says pipeline of new deals is strong, but that higher confidence among executives is needed to complete them? Wow, okay. So, this just shows you the level of confidence issues we have in this market, right? And I don't think I've ever heard a CEO come out and say that, other executives need to have higher confidence in order to complete these deals, essentially, at the end of the day. Like, literally, I don't think I've ever heard that in my life. Like, that's just crazy. But that's the moment in time we're in the market where no one has any confidence. People have no confidence in the folks, obviously, running the show, right? People have no confidence in the Fed. People have no confidence in the economy. People have no confidence in the financial markets right now. And it's just an overall, just, my gosh, do we have confidence issues going on right now? And when you start seeing an investment bank, come out and say that, there's confidence issues among executives, like, geez, it doesn't get more apparent than that, right? That's a moment in time. By the way, profit falling 29%, not a good look, obviously. If we go through these numbers, very worrisome. Net revenues were off considerably. The same quarter last year, $14.7 billion. They did $13.1 billion. That's a considerable decline there. Pre-tax income, $3.3 billion latest quarter. Last year at this same quarter, $4.5 billion of pre-tax income. So pre-tax income's down about, $1.2 billion. Net income attributable to Morgan Stanley, shareholders, $2.4 billion roughly. 3.5 billion was in the same quarter last year. So net income's down massively. Earnings per diluted share, $1.39 versus $1.85 in the same quarter last year. So, I mean, a return on equity, 13.8% in the same quarter last year, 10.1% now. So, I mean, Morgan Stanley's numbers are just not good. That's the best way I could put it. Not good. They're down massively year over year. And the big question is, do things continue to get worse? The chairman and chief executive officers had said, quote, overall, the firm delivered a solid quarter in what was a more volatile market environment than we have seen in some time. Strong results in equity and fixed income helped partially counter weaker investment banking. We continue to attract positive flows across our wealth management business, and investment management continues to benefit from its diversification. Finally, we finished the quarter in a strong capital position to ensure that we move forward with confidence. There goes that word confidence again. Oh boy, okay. There it goes again. Now, kind of reading between the lines there is basically what they're saying is, the IPO market's kind of dead right now and probably will continue to be dead for some time. In all these big Wall Street banks made a lot of money from IPOs, companies going public, and there was a hot market there for a bit. That market's done. Like, where's the big IPOs? Like, they're non-existent. They're not happening. They're not happening this year. The big question is, do they come back in 23? And I don't know. I would call that like a 50-50. Like, that's a coin flip at this point in time. I think probably 2024 makes a lot of sense. I think we'll be way past the wall of worry at that time, and we'll likely have already had some upward momentum in the market. And usually after you start seeing some major upward momentum, that's when companies start to consider, okay, let's go public. But right now, no. Not when there's no confidence out there. And who's got the appetite to go buy an IPO right now? No one's got an IPO. If you can't sell Amazon stock to people right now, no one's buying your flipping flapjack and IPO right now. If you can't sell Meta stock to people right now, no one out there is going to go buy some risky IPO right now, some new company going public. That's just bottom line. So basically, the only good thing about that is capital is going to go to current public companies rather than future public companies, right? Because usually if a company goes public, let's say, right, everybody gets excited about that. A bunch of money flows to that, right? And it kind of steals a bunch of money from the other public companies. That's obviously not happening anytime soon for at least this year, and probably even, like I said, it's like a 50-50 coin flip if it happens next year as well. So, moral of the story, no bueno. And confidence is a big issue out there, okay? Now, Morgan Stanley stock, I'm surprised. I was looking at this. That stock is only down 25% year to date. And I know that's in a normal year, that would be a disaster. It's like, what? This stock is down 25% year to date, and we're, I've only been through 6 months of the year, but, only a little over halfway through the year, right? But I mean, in this market, only down 25%. I'm amazed. To be quite honest. I thought that stock would be down a lot more than 25%. So maybe it has more to go downward there, okay? Now, this is interesting, right? Because if you remember, Morgan Stanley basically would have went under if it wasn't for the government saving them back in the day, right? Here's the deal. Morgan Stanley ended up getting saved in the great financial crisis, and Goldman Sachs as well. And a lot of people looked at that as like not fair, because there you had Lehman Brothers, Salomon Brothers, like a bunch of others basically go under, right? Or have to be sold for pennies on the dollar. And I mean, if you look at a list of the investment banks and just the banks in general that went under from 2007 to 2009, it is a ridiculously massive list. But Morgan Stanley and Goldman Sachs ended up getting saved, right? Which kind of says, like, why did those ones get saved and the other ones didn't get saved? And that's a whole big debate, right? But on September 19th, here's what happened, okay? Morgan Stanley informed the New York Fed on September 19th that it could not open on Monday. It could not open, right? And obviously the Fed came in and saved the day, and the rest is kind of history. And that forever changed the banking system to a banking system in which is ultimately supported by the Fed, the government, whatever you want to call it, right? And I know the Fed's not technically supposed to be the government, but let's be honest, it kind of is. And so that changed everything forever. And that's something obviously we don't have in the crypto market, right? And so you see all these, crypto companies obviously have gone under or have faced bankruptcy or liquidity issues. They got nobody there to save the day. And that's the way the banking system used to be. I mean, it used to be like if a bank went under, yeah, your money was FDIC insured, but if a bank went under, it went under. But what happened in ultimately 2008, that changed everything forever, right? And so just something to kind of keep in mind there. Now, JP Morgan fell on earnings to a new 52-week low. Well, yeah, it seems like every day JP Morgan hits a new 52-week low after 52-week low after 52-week low. So here's what happened. They had a double miss, first off. Not a disastrous double miss, but it's a double miss. And you can't come in with double misses in a scared market. You just can't, okay? I mean, you come in with beats and your stock might go down. Never mind a double miss. Earnings per share came in at $2.76. $2.88 was expected. Managed revenue came in at $31.6 billion. 31.9 was expected. So that's a double miss. It's not horrible, but it's a double miss. Now, profit declined 28% from a year ago to $8.6 billion or $2.76 a share, driven largely by reserve build, JP Morgan said. A year ago, the bank benefited from a reserve release of $3 billion, right? And so, slight misses for JP Morgan, but at the end of the day, it's a double miss, right? Now, part one of the scariness that is going on out there, okay? This is Jamie Dimon saying this, okay? This is his quote. Jamie Dimon, the CEO of JP Morgan and one of the most influential people on Wall Street and in global finance is Jamie Dimon, okay? This was his quote. Geopolitical tension, high inflation, waning consumer confidence, the uncertainty about how high rates have to go, and this is the scariest part, the never before seen quantitative tightening and their effects on global liquidity, combined with the war in Ukraine and its harmful effect on global energy and food prices, are very likely to have negative consequences on the global economy sometime down the road, okay? That's, I would call dire warning number one right there, okay? And like I said, the biggest thing is basically he's saying this is going to have negative consequences sometime. So basically, the way he's almost positioning this is we haven't even seen We haven't even seen the consequences yet, because he's talking about sometime down the road, right? Which could mean later this year, could mean in 2023. So here we are in this moment where JP Morgan just comes in with a double miss, and it's like, wow, we haven't even seen this yet? Oh my gosh, okay. But I thought this is why I had this in red. I thought this was just kind of the scariest part. Never before seen quantitative tightening, right? And their effects on global liquidity. And yeah, I mean, we've seen the liquidity issues and how fast these liquidity issues have, happened, right? And we've seen it, I think, play out in the crypto market the fastest of everything. But yeah, it's pretty clear there's already a liquidity, I would almost call it crisis right now. But it sounds like Jamie Dimon thinks things get worse. Part 2 of this, right? With his outlook, JP Morgan has opted to temporarily suspend its share repurchases. Now, first off, there's some debate about this. If JP Morgan opted to do this, this was their decision, right? There were some people who were trying to say, or the way I saw some media portraying it was like JP Morgan was forced to suspend their share repurchase. It doesn't look like that. When you opt to do something, you're not forced, right? So this could mean a couple things, right? Could mean JP Morgan thinks their stock's going a lot lower, so let's not buy right now. I don't know. I would call that a lower probability. But what this does show me in terms of basically suspending your share repurchase there is it shows me that they need to keep a lot more capital around, right? And they want to use that capital for the business, right? And they want to have, because if you spend that money on share buybacks, that money's gone. If you keep an extra couple billion on the balance sheet, you're in a better position, right? And so also think about this, right? If JP Morgan here's JP Morgan at a 52-week low, right? And maybe on its way to a multi-year low. Well, shoot, it's a great time to likely be a buyer of the stock, right? And for the company to buy back shares. And here we are in this position where there's already a lack of buyer demand for the stock. And JP Morgan could be out there buying the stock right now, but now the share buyback's been suspended. So that sucks, right? And I own JP Morgan in my dividends only account. It's a smaller position for me, but I own it. And I don't know, if this baby keeps falling, I'm going to have to buy some more shares. But it's just interesting, right? Like usually when your stock's at 52-week lows or multi-year lows, it's the best time to buy. But now this company's asked to temporarily suspend their share buyback. It's not ideal. It's not ideal at all, right? And so that's part 2 of this story, okay? Part 3 of the story. And this is maybe the craziest part of all this, right? JP Morgan Chase CEO Jamie Dimon didn't mince words when it came to a regulatory process that forced his bank to suspend its stock buybacks. Asked by veteran banking analyst Betsy of Morgan Stanley on Thursday about the Federal Reserve's recent stress tests, Dimon unleashed a series of critiques about the annual exercise, which was implemented after the 2008 financial crisis, which obviously took down the whole world economy, right? He said, quote, "We don't agree with the stress tests. It's basically inconsistent. It's not transparent. It's too volatile. It's basically, I'm not going to try to pronounce that word. I'm horrible, okay? And arbitrary." And so basically at the end of the day, to put that in simple terms, is Dimon says, get rid of this crap. It's a bunch of crap, and it's not transparent. It's way too messy, and it's, I don't want to say pointless, but he doesn't like it, right? Very, 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 very obvious, right? Now, here's the situation that's the scariest part of all this, right? And first off, let me just address this. Jamie Dimon, I think the stress tests are a good thing, in my personal opinion. At the end of the day, we saw what happened when the banks were able to run wild. We already watched that play out. And pull up a list. You can find it on Wikipedia or whatever, all the banks that went under in the great financial crisis. Do we want that again? Do we want a situation where, Goldman Sachs and Morgan Stanley and all these big banks have to end up being pulled out and bailed out by the government? So I think the stress test is actually a good thing. And at the end of the day, these are basically just parts of the Fed now, in my personal opinion. When it comes to big, huge banks now, they're just part of the Fed. And so if you're going to be part of the Fed, then you got to abide by its rules. Bottom line, okay? So this is quite interesting. Under the exam's hypothetical scenario, JP Morgan was expected to lose around $44 billion as markets crashed and unemployment surged, Dimon said. He essentially called that figure bunk on Thursday, asserting his bank would continue to earn money in a downturn. Now, we'll talk about that in just a moment. But it's interesting that the Fed had this scenario play out where JP Morgan was to lose $44 billion in unemployment surge. Man, I can tell you, if JP Morgan lost $44 billion, boy, would the economy be in a mess. Oh my gosh, okay? Hope that JP Morgan never loses $44 billion, because I'm telling you guys, that would be a disaster. And I mean, the unemployment rate would be ridiculous for something like that to happen. And just like, that would be as bad, if not worse. Actually, it'd probably be far worse than the great financial crisis in that sort of scenario, right? Now, once again, I'm fully on board with, I think the stress tests are good. And even as somebody that owns some stock in JP Morgan and might own more in the future, I like the stress tests. I think it's good. Go through these hypothetical scenarios. Go through a scenario where the company loses tens of billions of dollars on the bottom line. I would rather have that than just like let the banks run wild and do whatever you want and da-da-da-da. No. Okay, so I'm all for this. I think it's good. Does it limit profitability of the banks? Yes, absolutely. But at the end of the day, banks are really there to serve the overall economy, right? And if they are able to act insane, then they're not going to serve the overall economy. They're not going to serve the people, right? And so I think there's just something important to kind of remember there, right? Now, to stick up for Jamie Dimon, if we look at the net income of JP Morgan during the last financial crisis, they had positive net income, right? And they made money still. So I want to stick up for him in that case, but I still think the stress tests are a great thing. I think they should keep those. And I'm all for it, man. Like I said, yeah, it's going to limit banks' earnings. It's going to limit share buybacks. It's going to limit dividends, all that. But hey, at the end of the day, we'd rather have that scenario than banks run wild, because we've seen what plays out if you let the banks run wild, man. They'll start doing riskier and riskier business. They'll start doing riskier and riskier loans, and they will end up getting themselves into trouble. And in the short term, their EPS will fly to the moon. And all of a sudden, it's like, oh my gosh, the big banks are taking over. Look at how big the market caps are. But I just don't think it's healthy, right? The banks should be there to serve the overall economy. That's why they're there, right? So it's official, folks. The track meet has started now. Earnings are underway. This is going to be a very busy earnings season. As far as what everybody's looking at next, they're going to be looking at a lot of the I can call it Dow 30 companies are going to be very, very important. And then after that, it's big tech time. And big tech, we know how big those weights are because of how many of those companies have hundreds of billions of dollars in market cap, if not $1 trillion plus, right? And those babies will move the market up or down. And that's what everybody's really looking at to get any sort of confidence. If big tech comes in unconfident in their commentary, we're going to remain in a stock market that just has no confidence, right? Which is going to be hard to get it to make any upward move, at least in the short term, right? So anyways, guys, I appreciate you joining me. Thank you so much. Yeah, it's a busy video. And also, if you enjoy the videos and you ever want to say hi, follow me on Instagram, Financial Education Jeremy, and send me a DM. I'm always there. Much love as always, and have a great day.